some of you might remember back in the 80s, if you wanted to buy a private house, you had to get a loan from a building society, not a bank, a building society. And the building society would say, well, we're only going to lend you about maybe 2.5 times at the most your annual income. And that had a leveling effect upon the house prices as well, a stabilizing effect. The building societies also would only lend money that they had in their savings accounts. And so if they didn't have a big enough savings account, if there weren't enough people saving with them, they simply wouldn't have the money to lend you. And again, that had a stabilizing effect because it meant that house prices stayed at the same level approximately as the nation's savings. Now, that did mean that mortgages the interest rate was often high, but it also meant that mortgages were often shorter, and they were, provided you still stayed in employment, they were serviceable. But then a certain lady came along, who shall remain nameless, and got convinced by her City of London financier class colleagues that what they ought to do was to open up the mortgage market to their chums in the banking sector, to allow commercial banks for the first time to lend for mortgages. And this was transformatory because, unlike building societies, banks were not and are not limited to simply lending the money that they have in their savings accounts. Banks can lend money which they don't have